Hello, I'm Kathy Petroni, the president of the Lansing Area League of Women Voters. Welcome to our webinar, Green Investing or Go Green to Get Green. This webinar is the work of a partnership between EGERS, which is the environmental advocacy group of the League, and CAFE, which is the Capital Area Friends of the Environment. The League is proud to host a seminar since the League supports protecting our environment, and we believe in climate change. Please note that the information shared in this webinar is not intended to be financial advice. The webinar is being recorded. During the webinar, your microphones will be muted and the chat function will be turned off. You can submit questions in writing as they arise. When you submit your question through the Q&A, you can put what slide that question pertained to. We have a league member, Laura Rogers, who's going to collect the questions. She's going to collate them and organize them. And at the end of both speakers, each speaker is going to speak for about 20 to 25 minutes. When both speakers are done, then Laura will share the questions with the speakers. If we have time at the end, we can also take questions from the floor. We plan to finish no later than 8:30, so we're going to try to keep that on schedule. So next up, we have Ellen Link, and she's the co-chair of EGERS, and she is going to introduce our first speaker.
Our first speaker this evening, Henry Shilling, has worked in the investment management industry or focused on the investment sector for 50 years. Am I supposed to keep going or change the screen? Henry founded Sustainable Research and Analysis, LLC, 7 years ago. The firm focuses on sustainable investing research and analysis, as well as education, training, and consulting services in the area of sustainable finance. While employed for 25 years at Moody's Investor Service, Henry initiated and coordinated Moody's efforts to disclose and add transparency in research, ratings, and analysis to reflect environmental, social, and governance, ESG, risks and opportunities. He also led the firm to launch and successfully implement a methodology for assessing green bonds worldwide. Over the years, Henry published research articles in these and other capacities, was a frequent commentator, and regularly presented Moody's views at various industry conferences. Henry, take it away.
Ellen, thank you so much. And thank you, Elaine, as well as the Lansing League of Women Voters for this invitation to participate in your webinar. I'm very pleased to be with you virtually. I'm physically located in New York City, in Lower Manhattan to be exact, in the financial district. So what I've done is organize my remarks along the lines that were designed to capture as much as possible 10 topics that were identified for me by Elaine. And let me open up my presentation. I can't seem to be advancing my slides. I am not sure why that's the case.
Perhaps try a mouse click to advance the slides.
Okay.
Page down key or down arrow key or the mouse click. One of those should work.
Very good. So as I said, I've organized the discussion into 3 segments to reflect the 10 or so topics that Elaine had shared with me. And these are sustainable investing approaches and implementation, Second is green, social, and sustainability bonds. The third segment focuses on sustainable investing, point and counterpoint, where I try to capture all the items that I couldn't capture under the first two segments. And then I've included some resources that may be helpful to one or more of you, should you decide to examine at least three areas that I focus on in the resource document. But before I get started, I want to just identify maybe a couple of key takeaways. The first thing that you should understand is that there are no universally accepted terms and definitions in the area of sustainable investing, strange as that may seem. But terms such as ESG, which, as was mentioned, stands for environmental, social, and governance. The individual terms E, S, and G, or sustainable investing or sustainable investment are not formally defined, and there is no universal consensus on what these terms mean. So this, in my estimation, is in large part responsible for a lot of confusion and misunderstanding that is evident today regarding ESG investing and sustainable investing. And it is in part, I believe, the basis for some of the pushback that we're observing taking place in the US in particular. The second point is that sustainable investing means different things to different people. That said, even as you will see that the universe of focused sustainable mutual funds, which I will be talking about, is constrained, it is possible still to construct a diversified, sustainable portfolio that meets not only individual investors, but also institutional investors, their financial and sustainability preferences. I should say sustainable goals and objectives and sustainability, financial goals and objectives and sustainability preferences. And one way that this can be achieved is by combining public and private local investment opportunities. The focus of my remarks is on the public markets, where I actually spend most of my time looking at securities, looking at mutual funds, and looking at exchange-traded funds, all through a sustainability lens, while Tom, who will follow my remarks, will focus on private local investment opportunities and investment perspectives. So, oops. As I said, there are no universally accepted definitions for sustainable investing, but many practitioners agree, and this is what I try to set out in this, what is sustainable investing? Many practitioners agree that sustainable investing refers to a range of approaches by which investors aim to achieve financial returns while promoting long-term environmental or social values. Note that I don't use the term outcomes, values. And such approaches combine traditional investment approaches with environmental, social, and governance insights that lead to a more comprehensive analysis and better investment decisions. This is a pretty busy slide, but I think it's an important one. Most practitioners in the sustainable investing sphere acknowledge that there are 6 sustainable investing approaches. And these approaches are identified on the left-hand side of the slide. And I'll run through this because, as I said, I think it's fundamentally important, but it also tracks the various investment product offerings that are available in the form of mutual funds and ETFs. So the first one is a values-based approach. And this is a strategy that's based on a set of beliefs with a view toward achieving positive societal outcomes. Examples here include faith-based or religious-based mandates, ethical approaches or mandates, moral or social values. And typically, these approaches are carried out through negative screening, divestment, or divestiture. You'll see examples of some of that in the screening and exclusions approach, which is not only part of a values-based investing strategy, but it can also be implemented on its own in order to appeal to the needs, goals, and objectives of investors who may be investing in ETFs and mutual funds. So stocks, bonds, and other instruments are overweighted or underweighted in portfolios based on their ESG scores or other considerations, or are excluded in their entirety. And this includes companies or certain sectors or industries, for example, alcohol, tobacco, firearms, fossil fuels, atomic energy, serious labor relations actions or penalties, compulsory child labor, human rights violations, or genocide. This is just a partial list. I can go on for quite a while, identifying areas that are either screened for or excluded altogether. The third approach under the sustainable investing umbrella is impact-oriented. Here, impact in a narrow definition means investments that are incremental or additional, that are directed to companies, organizations, and funds with the intention to achieve measurable and sustainable environmental impacts alongside financial return. The fourth is thematic investing. These are investments focused on a particular idea or unifying concept. For example, clean energy, like solar power, clean tech, gender diversity, the environment, or low carbon. And they also include this approach. The thematic approach also includes investing in green, social, and related bonds, which is a topic that I'll cover as well. The fifth is ESG integration. And ESG integration means that relevant factors, and those factors are identified on the right-hand side of the slides, and you can see some of the issues that are considered as being relevant factors, even though there's no universally accepted definition on what those might be either. But these are the factors. This is a strategy where the factors are systematically and consistently analyzed, where these are deemed to be relevant and financially material to investment decisions. And the focus is on risks and opportunities. And last but not least is engagement and shareholder action and proxy voting. And this is where investors leverage the power of shareholder ownership in publicly listed companies. And these might be in order to influence companies and their behavior, or just to gather information that enables investors to make better decisions based in part on the strategies that the companies are employing in relevant areas. And then finally, proxy voting and/or filing shareholder proposals. Those constitute the 6 strategies that are not mutually exclusive. So in fact, these strategies can be mixed and matched, and you can have an impact strategy that also combines ESG integration, or you can have a thematic strategy that combines screening and exclusions. Having listed these 6, what I would add is that, or what I would emphasize is that by far, sustainable investing is dominated by 3 strategies. The first and foremost is ESG integration. The second is engagement, shareholder action, and proxy voting. And the third includes screening and exclusions. Now, here's a chart of assets that are attributable to focused sustainable funds. What do I mean by focused sustainable funds? Focused sustainable funds, which include mutual funds and ETFs, are defined as funds that focus on sustainability, impact, or environment, social and governance factors based on the fund's name, an explicit strategy set forth in the fund's prospectus, or regulatory filings, or a related thematic investment mandate. The important takeaway from this slide is that there are only 591 mutual funds that qualify under this definition. There are a total of 1,380 share classes. If you're not familiar with a share class, that's a designation within a fund that's geared to a particular investor based on a different cost structure. And in total, these funds represent $353 billion at the end of 2024. What you can see from this chart is in 2022, assets declined. Assets declined across the board for mutual funds and ETFs, but a criticism of the sustainable funds approach, or one of the criticisms, is that these funds outperformed during the down market that we experienced in 2022, during the COVID period and at the beginning of the invasion of Ukraine. And the reason that they actually underperformed, they did underperform, although it's actually even difficult to compute the degree to which they did relative to conventional funds. The reason that they did is because sustainable funds tend to be underrepresented in energy and overrepresented in energy, meaning oil and gas exploration companies, overrepresented in investments in energy companies such as renewable energy and so on. And they're overrepresented in technology companies. And energy prices rose rather dramatically once Ukraine was invaded, which benefited those funds that invest in oil and gas exploration companies, but it detracted from the performance of sustainable funds because of their low exposure to that area. By the same token, technology companies and sustainable energy-oriented firms suffered because of high interest rates and inflationary expectations. So they will, from time to time, underperform, but at the same time, they will overperform during other periods. That is not to say that we should expect sustainable funds to achieve lower or higher returns over the long term. Studies show that it is possible to achieve market-based rates of return with investments in sustainable funds. All of that said, the range of investment product offerings in the sustainable investment space is actually constrained somewhat. The funds are smaller in size. There are fewer investment management firms offering the products. And also, there are limitations in terms of the types of funds that are offered. And that makes creating a portfolio of such funds a bit more challenging. This is a comparison between the universe of sustainable mutual funds and ETFs versus conventional funds. And the key takeaway here is that sustainable mutual funds and ETFs represent just 1% of the total $36 trillion that is invested in mutual funds and ETFs in the US. Here is a list of 10 fund companies that manage sustainable long-term mutual funds. You probably recognize these names like BlackRock, which offers iShares ETFs, Vanguard, Parnassus, Calvert Research, which is owned by Morgan Stanley, Nuveen, which is owned by TIAA, formerly known as TIAA-CREF, dimensional fund advisors, and so on. These firms control 73% of the assets in the sustainable investing, in the focused sustainable investing mutual fund space. So it's fairly concentrated, and it's also concentrated by the number of funds in the area. I said earlier that the space is constrained by fund sizes, but meaning that there are many more smaller funds, which by virtue of the size tend to be less efficient and more costly. But that is not to say that there aren't a good number of large-sized funds that one can take advantage of. And funds like Parnassus Core Equity or Vanguard FTSE Social Index, iShares ESG, and even Nuveen has the largest Nuveen Core Impact Bond Fund at $6 billion. Just quickly, what are the drivers of sustainable investing? What's motivating investors? And what you can see here is that two-thirds of investors embrace or integrate sustainable factors for risk management considerations. That's both on the equity side and the fixed income side. Almost two-thirds of investing is driven by client demand. Regulations is about 18%. Achieving better returns is accounted for by 16% of the respondents. And fiduciary responsibility considerations runs between 15% for equity investors and 9% for fixed income. So the lion's share of demand is coming from investors who are concerned about risk management. They want to take climate change into account when they invest in securities, and clients are demanding these types of products. And notwithstanding all the top line noise that we hear about the pushback against ESG or the pullback on the part of investors, the latest study, and this was that I've seen, and this was conducted in the middle of last year, so it doesn't bring us to the assumption of the Trump presidency in January. The latest study shows that global ESG adoption remains at an all-time high. And while this is slightly out of date, there are more studies that confirm that, and I'll identify one at the very end of the presentation. For investors who are interested in investing sustainably, as would be the case with respect to conventional investing, there are three really basic options. One is a do-it-yourself approach, another is to engage an advisor, and the third is to use a robo-advisor. I'm not going to get into the details now. I'll just say that if you are a do-it-yourself advisor, a do-it-yourself investor, you basically have to go through 5 different steps. And those same steps are going to be relevant if you entrust your money to a financial advisor or a robo-advisor. The 5 steps are: first, you have to formulate a financial profile for defining goals, risk tolerance, and investment time horizon. You have to define your sustainability preferences. You have to design a complementary investment portfolio, a investment portfolio's asset allocation, which is based on the goals and objectives that you established previously and your preferences. And then you have to go through the process of analyzing and selecting mutual funds and ETFs. And then after having selected them and placed them in your portfolio, based on a asset allocation model, you have to monitor, update, and reallocate your investment portfolio. At the very least, when it comes to selecting mutual funds, 5 key determinants that ought to be on your checklist or on the advisor's checklist are: what is the quality of the management company? What's the size of the fund? How much are they charging? What's been the track record? And how long have they been in business? At the very least, as a starting point. So with that, I'm now going to move on to sustainable debt market instruments. And I think I'll be actually running out of some time. So what I will say is that, at least in this slide, I divided sustainable debt instruments into two buckets. The first bucket includes securities or bonds that are classified as use of proceeds bonds. And in the second bucket are other forms of sustainable debt instruments. Use of proceeds bonds are bonds where the proceeds of the bond issuance are specifically designated. That's not the case for other forms of sustainable debt. And examples of use of proceeds bonds include green bonds, bonds that invest in renewable energy projects would be a category of green bonds. Social bonds are an offshoot of green bonds, and here the proceeds are designated for use in connection with socially beneficial projects, such as building low-income housing or providing healthcare services. Sustainability bonds combine both green and social objectives. And then we have niche products like blue bonds, gender bonds, or orange bonds, and SDG-linked bonds, which are targeted at specific objectives. It could be to eliminate gender inequity, for example. I'm not going to go through the history of green bonds, but what I will say is that a green bond is a fixed income instrument where the proceeds, as I said, are exclusively applied to finance or refinance new and existing eligible climate and environmental projects. In all other respects, a green bond functions like a conventional bond, and that is really the reason for its success. And what I mean by success is that $1 trillion in green, social, and sustainability bonds were issued in 2024, and 60% of those were green bonds. In many cases, bond indenture language that are associated with use of proceeds bonds tend to be vague, and they're vague not to hide anything necessarily, but really to limit potential legal liabilities. Credit ratings of green bonds are equivalent to their conventional bond counterparts, although there are some exceptions. Labeled green bonds are issued pursuant to the green bond principles, and I'm going to let you review the principles on your own, or I can answer some questions about those at the end. But in addition to the requirements that are set out on the right-hand side of this slide, the green bond principles also recommend but do not require an external review. About 75 to 80% of the bonds issued throughout the world do carry an external review. To illustrate a green bond, I just want to note that in 2022, the University of Michigan actually issued $300 million general obligation bond, which qualified as a green bond. These were 300 million of taxable bonds. It was issued in denominations of $1,000. The projected interest rate was 3.5% annually, and these were due in 2052, which means that these were 30-year bonds. The bonds were certified, and they were used to finance several construction and renovation projects on the Ann Arbor campus of the university, including building new undergraduate residence halls on the North Campus, continuing work on the new Michigan Medical Clinical Inpatient Tower, and replacing the Central Campus Recreation Building. So the green bonds were designed to enable the university to pursue the goal of becoming carbon neutral by 2040. And I mentioned this not only because of the proximity to Lansing, but also because you can still purchase bonds in these bonds in $1,000 increments in the secondary market today by going through your broker. I'm going to skip the other types of bonds for the time for now. I will also say that if you are interested in green bonds but don't want to make individual security decisions being a do-it-yourselfer, there are 9 green bond mutual funds and ETFs that are available for purchase. These have performed very well in the last 1, 3, and 5 years and have beat conventional benchmarks. So these opportunities exist. And finally, on reporting and disclosure, this is an example of a report that is issued by BlackRock iShares that identify the benefits that were derived in their portfolio by investing in green bonds. The reality is that reporting and disclosure in this area is still pretty weak, but some companies do a better job of that than others. And I think I've run out of time to review point counterpoint, but it is something that I can come back to at the very end. So thank you very much, and I apologize for going over my time.
Thank you, Henry. I'm Elaine Fishoff. I'm co-chair of the Environmental Advocacy Group, and I'm introducing Tom Stanton. Tom Stanton is a retired clean energy policy analyst with over 40 years experience in state energy and public utility regulatory policies. A lifelong resident of Michigan, Tom's previous work in state government included 10 years at the State Energy Office, followed by over 22 years as a staff member of the Michigan Public Service Commission. He is also a board member with CAFE, our co-sponsor. He will be sharing his extensive personal experience in green investments. Tom?
Okay, thank you. I really appreciate the opportunity to talk with you all tonight, and I'm very happy to see so many people I don't yet know on the call, hoping to learn something about green investing. So I'm going to tell you a lot about my personal experiences with green investing, which has been an interest for quite some time. We'll talk about some of the current opportunities or immediate opportunities for doing green investing at the local level and the with some alternative kinds of investments. I think Henry has done a fabulous job summarizing a lot of what goes on in the major kinds of markets that we can all invest in also, but I'm going to focus more on some of these smaller and more local opportunities. And I want you all to understand that these are areas that I am personally working on, and the Capital Area Friends of the Environment is doing some work to try to hold conversations with others about how we can make these opportunities work better for mid-Michiganders. And we welcome your interest and support in participating with that. I also want you to understand this disclosure for the audience that I am not trying to give you legal advice or expert investor guidance. I'm going to tell you about my personal experiences. I love the cartoons by a cartoonist named Dave Carpenter, and he agreed that we could share these with you. And I think this is apropos for tonight's discussion. I want to first of all talk about a couple of things that have to do with the questions that Henry was raising for us all about how is it that we are screening our different kinds of investments to decide which are green or which are sustainable. And I am a student of and a follower of the United Nations Sustainable Development Goals, called SDGs. Here are the 17 major goals. The 17 major goals also break down into something like 160 more specific ideas about how we are going to achieve these things. Affordable and clean energy, number 7, has been the focus of my career and my work. So when I learned about these, I started to, delve a little bit deeper into what they are, how they work with one another, who else is working on these, and how might we be able to use these in our own world as we think about where we would like our investments to go. In addition, on the left side of this slide, you see I've said there are a dozen comprehensive design guides and frameworks for understanding what is sustainable or what is not sustainable, and how can we try to focus in a comprehensive way about understanding all the different aspects of defining sustainability for ourselves. The underlined part there is a hot link to a web page that I have been editing that includes a list of those design guides. This is just a couple examples of charts that are used to take a look at how different techniques or different projects relate to the 17 different United Nations sustainability goals. And they're come from 2 different sources. The sources are here. You can study these later. But to me, the interesting idea here is that any particular kind of investment can now be scored to identify how it will help to achieve any or all of the 17 different goals. And those scores can be converted into, sort of a numerical index about each project or each type of investment, which I think is very helpful. Not the kind of thing that you're likely to want to do for yourself, but more and more you'll be able to find those for investments. Now, as I'm starting to talk about what are these current opportunities and how would you screen for the kinds of investments that you want to make, I wanted to raise this basic idea that we're looking for opportunities where we can know ahead of time for the investments that we're going to be involved with, who are the people that are involved, what is it that they're going to be doing, where are they going to be doing it if we care about our local investments in our own hometown or in our own neighborhood. When will the earnings be accruing? And when is also very important to ask about how liquid your investment might be, because some of these newer and less well-known investment types are less liquid. They might have to be held for quite some period of time, and there isn't any easy, quick market if you had to turn around and sell your investment in one of these things. So these are all concerns that each individual has to have and consider for themselves. And then I want you to understand this concept called project financing and why project financing is so different from other kinds of investing. When we're investing in a specific project, the engineering analysis and the analysis that's done prior to making the investment helps to determine what are the risks and what are the returns for that opportunity. I think the easiest way to think about this is for energy services coming to pre-existing buildings, coming to pre-existing factories, making changes to be more energy efficient. And in the United States, this is already a multi-billion-dollar per year industry, but it's also heavily focused on the most giant consumers of energy. So Ford Motor Company has done some corporation-wide projects using these kinds of services. General Motors has done it. Giant corporations have made a lot of progress in reducing their energy use because they can attract energy service companies that know that with one signature from one corporation, they might have the opportunity to earn hundreds of thousands or millions of dollars by reducing very, very, very large utility bills. I'm very interested in how we bring all those same capabilities to much smaller energy users, all the way down to the level of single family homes. And so that's an interesting target to me. And then at the bottom of that slide, I mentioned we don't have to be waiting for new laws, new rules, new changes in how we regulate our utilities or changes in what our local governments are ready to do. Some of this we can take upon ourselves and just start doing right away because the opportunities are very well known and rather easy to target. These avenues or these realms of where we might invest are already very well known and areas that we can strive to move into on our own, one investment at a time. So I've mentioned already this idea of energy optimization or energy waste avoidance. The Michigan legislature a few years ago called this energy optimization, and I really appreciated that use of the terminology. Now they want to call it energy waste avoidance, and it's a little different, but kind of similar. Also, into a portfolio of any kinds of energy projects, we can add clean energy production like solar, wind, hydroelectric, many, many technologies for drastically reducing fossil fuel usage and the emissions that come from fossil fuels. There are at least 100 different technologies either invented in or manufactured in Michigan or both that are ripe for investing. And that's an area I'm very interested in seeing if we can pursue in a more systematic way. And then we can reduce our own risks by diversifying into all the different types of investing that Henry has spoken about. Our EIT stands for Real Estate Investment Trust. And there are many different focus markets for those things, including clean energy, food and agriculture projects, water and water infrastructure, and many more. So now I'm starting to get here into my own personal history. And on the left are a bunch of different types of investing that I've started into myself. I'll go into some more of that in a minute. The picture in the center of your screen is my house that my wife and I own, the Darius B. Moon Historical District house in Lansing, Michigan. It's an 1890s Victorian and has taken lots and lots of our capital to invest in and try to maintain and keep up this historic building. That's one of our hobbies and interests, and we consider that one of our investments. We may not ever get every penny out that we put in, but we're also very happy to be the stewards of this rather incredible historic district house. At the bottom here, you see I have personally invested in my own home energy efficiency, and I did it through 3 tranches. If you don't know this word tranche, it's a French word that means a cycle of investing or a year of investing. And I've done it approximately 3 times for approximately $3,000 each time. And in the first house, I did it twice, and each investment of about $3,000 was cutting my utility bills by $100, $200, $300 per month with, very reasonable returns on investment. So this is a really valuable strategy. No matter what else you are thinking about, no matter what other opportunities you might have, if you put your own money into energy for your own home, or your own business, or your own school, or your own religious organization, the return on that can be quite generous and as good or better than returns that you might expect from any other kind of investing. So, do it yourself first where you are. That's a really good way to make some money by saving some money. I participated in the very first community solar program of the Lansing Board of Water and Light. renting what they told me was panel number one, the very first of 1,000 solar panels, and I get the output of that panel credited to my utility bill every single month. I was able to join a Solarize program in Lansing that is called Solarize, and it means a bulk purchasing program. As it turned out, 11 homes and businesses agreed to purchase solar all at the same tranche with that program. So we got an 11% discount on the full cost of our solar installations. Mine includes solar power plus batteries in the house and enables us to ride through short-term grid outages because our batteries can power essential equipment in our home. I've now added a new DC battery charging option, and I'm going to be making a mini case study about that work. I'm using a DC battery, charging it with the solar energy or the cheap electricity that comes certain times of the day, and use it to charge up all my different DC appliances in the house, which already include my laptop computer, my cell phone, different lamps in the house, different tools, and so forth. And I have a hybrid electric bicycle already, and in the future we'll undoubtedly be expanding our electric vehicle options that we have in our family. Also, at the very bottom here, I do have a small fine art collection and a collection of historical musical instruments. We don't know exactly what the value is, but I've been told some of the musical instruments have increased in value by about 10 times during the 20 years that I've owned them. So that's a pretty good return on investment. There may be some opportunities that are unique to different people. Next slide here on the donation-based experience. One of my very first experiences was a success with a local Lansing restaurant named The Avenue Cafe. They needed $1,500 very quickly in order to acquire their beer and wine license. So I spoke with the owner, operator, chef, and explained that I had already read about a technique for doing this. Why didn't that person ask people to contribute $150 each? Later, she can pay them back $150 or more of service at the restaurant. And in the meantime, she'd be able to use the $1,500 to go get the beer and wine license, and it worked. They did it. It worked. They got their beer and wine license in a much more timely manner. And then over time, I earned my $150 back by having a big dinner party at the restaurant and with, special Michigan whitefish dinner. It was really fabulous and an interesting kind of an inside game about how can we invest in something very, very local and have them support the repayment, not necessarily all through cash, but by them providing something that they can value at wholesale, becoming something to me that I can value at retail. I also invested through Kickstarter kinds of campaigns in some of my Michigan musician friends who were asking us to prepay for their new recordings by providing money upfront so they could afford the time in the recording studio and so forth. That worked very successfully a couple times, and I've got now the autographed music from several of my groups that I really like. I had similar good experiences on Kickstarter and Indiegogo, but here also I want you to realize I had some failures. I put some money into Kickstarter or Indiegogo projects thinking I would get the offered and promised reward of some product, but those different companies, for various reasons, never provided what they said they might provide and walked away with the cash. So that was not such a good experience, and I'm much more careful how I might think about doing that now. Another important transition for me was through all these experiences, I became a lot more cautious about my crowd donation options and switched more and more to crowd investing, which I'll tell you more about in a minute. And I switched my own personal buying habits so that I have 10 months of the year where I try to not buy anything that's not really needed, and only 2 months of the year where I set myself a limited budget and treat myself to other things that I think I might really like, but trying to become more and more conscious of what it is, why do I think these things will make me happy, and in the meantime, saving money that I otherwise would have spent on who knows what. On the right here is the link to the Earthwork Music Company where you can see what they're up to. And now in 2025, the first time I'm mature enough now that I have to start taking my IRA minimum required distributions every year. And I will be focusing on trying to find local groups that I can contribute to where I'm making an impact through those investments, and they will be doing good local projects. And they're in order to do that without anybody paying taxes on the money, we give to educational organizations that have the 501c3 tax exempt status from the federal government. In specific small local investments, I made this set of investments through a crowd investing platform named Raise Green. That's a hot link that would take you to the Raise Green page. Raise Green is in the process of being subsumed into a larger platform called Honeycomb, but you'll see some more here in a minute about it. But these are the examples of different projects I invested in. A climate impact note, a 2-year note with 8% annual return. The Connecticut Green Bank. Connecticut Green Bank has been raising money. They use it to lend out for their green bank projects. And they're one of the same capital providers that serves the Michigan Green Bank that is called Michigan Saves. I was one of the founders of the Michigan Saves program, and very happy to see they have now achieved their first $500 million of successful lending to people to do energy efficiency programs in their homes and businesses. The National Energy Improvement Fund invests in helping buildings reduce their energy usage. Part of their capital stack is made up of this kind of very small equity investments on the part of crowd investors, as little as maybe $1,000 per investor per tranche. And their most recent tranche is 7 years, offering a 7% annual return. So, you can see several of these investments are as good or better than CDs at the local bank, or a lot of other kinds of investments. And as long as all these are taking place inside my IRA, I'm not paying taxes on the increases in value over time. It's just adding to my IRA. So I've been using a self-directed IRA to do all that. I had these couple of failures here, so I wanted to also say, hey, this isn't perfect. And if we're not careful, no matter how good the investment looks, we could still lose our money. So I ended up losing $3,000 on a project called Ola Filter, and there's a description on the left there. I don't know how they didn't succeed. They had a fabulous product that would save lives by the hundreds in different contexts in low income places in the world. Especially they operated in Guatemala, but somehow they could never get the market going. And so they've folded up their operations and gone under. The same with this audio company. I bought some of their audio equipment. It was the most fabulous, wonderful audio equipment I'd ever seen. And the guy who founded the company was very successful with some other companies. The thing that made this so fabulous was its very, very, very small size and really great capabilities, but they got snuffed out during the COVID era because of supply chain interruptions. So, I don't want you to think that this system I'm talking about is perfect. We could also lose some money. How do you think about doing this and doing it quickly or doing it immediately? First, I suggest you find your own fiduciary investment advisor who can help you manage your investing while keeping your personal interests as their number one goal, not their own aggrandizement or their own wealth growing, but your wealth growing. And I happen to find one that I trust. They've been doing a spectacularly good job. And I'm not trying to recommend any particular one, but at the end here, you'll see I'm a supporter of and follower of the National Community Capital Coalition. And if you want to look through to see who's from Michigan, who's been a president now or a past president of NC3, you'll find somebody you might want to talk with about this kind of investing. There are these federally approved, many federally approved platforms that have to follow the rules that are in the federal government regulations about how we're going to manage small crowd investing. And so those are places you can learn about them. You can learn what they are. And here's a list of options through Honeycomb. Honeycomb is now the parent company that has subsumed Raise Green inside. This is one that's open right now for Michigan. And just during the time I was working on this presentation, a second Michigan investment has opened up. You'll see that in a second. This is the kind of basic information you can see about each one. You can look at who the people are, look at the summary of whatever their deal or their offering is, and learn a lot about it before you invest. Here's a list of Michigan projects. All the ones that say funded, they've already been successful at using this platform to gain funding for themselves to go forward. You see a whole bunch of different areas here, restaurants, food, and automobile repair shop in Southfield, luxury fashion house in Detroit, all different kinds of things. It's up to you to see what's available, study it, decide what you want to put your money into. But this kind of platform, I think, makes it a lot easier. These are not Michigan ones. These are nationwide. But a couple things to notice here is many things that are really closely related to the environment and ecology. And the ones with the red borders around them have special perks that go to the investors from those entities. So like if you invest in the Brooklyn Grocery Cooperative in Portland, Oregon, you get 10% discount on everything you buy there and special deals that are only going to go to the members. The PA Boys Barbecue will give you a $50 credit on their catering business. And if you want, you can get the t-shirt and the hat and other, swag that comes from that company. The ones with the green borders now, there's two in the top row and one in the bottom row at the right. Those are Raise Green opportunities. So now that Raise Green is incorporated into this platform, they're starting to differentiate and show the Raise Green offerings that all have to do with climate action programs and climate action projects. Main Street Journal is a project of one of my mentors, Michael Schumann, who is one of the premier researchers about local investing in the country. And he's listed, or he and his colleagues have listed these opportunities for small scale investing. They're listed on that journal. I believe people have to get some kind of membership to see the listings, but this shows what the listings are and which exchange they're listed on. You see here, WeFunder, Start Engine, and Small Change. Those are three of the premier platforms for looking into this kind of investing. There are many, many more platforms. Here's a few that come from Start Engine. I picked these because they look most interesting to me. You know, they may have hundreds on each platform, but this gives you an idea what people are looking for. Some of these are quite big. The first one raised already $5 million. So, you know, some of these are much bigger than others. Some are as small as just 10,000 or 20,000 for a project. And there's a great deal of variety. Here's my section about future work, and I'm going to go very quickly, but contact me afterwards or make sure to get in touch with the league so you can find how we can talk more about this. We're going to try to keep this conversation going as we get together with other people in Michigan and try to figure out what are more targets we can work on together and how can we make this work really well. There have been very important new laws introduced in the Michigan legislature, but not passed. And so, you know, we're hoping that in the next legislature, maybe some of these laws will move forward and make it easier and easier for us to do these things. I won't try to read any of it to you. You can ask your questions if you have more later. I'm asking you these questions. You can help us identify what are the sectors of Michigan's economy that are regularly doing project financing of $1 million or less. If they're more than $1 million per project, they probably have their own way to finance these things and may not need our help as small investors. But if they're much smaller projects, they have much more trouble getting bank financing and might want to look to small investors to help them do their projects. And these are some targets that I've already identified, and I'm already starting to talk to people about setting up special funding through equity crowd investing for those 1, 2, 3, 4, 5, 6 different kinds of project ideas. You very well may have other great ideas that I haven't thought of, and that so please send them along and keep this discussion going. Last, you get a list of citations where you can go read more about these ideas and who's doing what in these areas. This National Coalition for Community Capital meeting, in cooperation with Michigan State University's economic development programming, is at the Kellogg Center March 7th all day long in Lansing. You know, please go if you can, or send your representative to participate there and learn more about these issues and what's going on. And finally, I've been assembling this poster that our local group cafe might be able to show at that March 7th meeting to help other people become interested and join us in this discussion and in this activity. Gee, that was a lot of information, and I hope you found it helpful. And now we really look forward to the conversation. Thank you all for your time.
Great. Thank you so much. That was fantastic. My name is Laura Rogers, and I have been a member of the League of Women Voters Lansing area chapter, and also a member of the environmental advocacy group for about 8 years now. And so I really enjoyed this this presentation. I'm going to run right out tomorrow and talk to my financial advisor. That is number one on my list. And it's a big list. So, but we have some really fascinating questions I'd like to share with you. I'm going to get to the shop type questions first because there were a few of those. One of our participants asks, and I know Henry, you had spoken about this, but I'm sorry, Tom had spoken a little bit about this, but our participant wanted to know if Henry could chime in, and that is, Are there any funds aligned with the UN SDGs, and are they growing in number? So who wants to go first?
I'm happy to start, and Tom can follow me. I guess there are a couple of ways that I can answer the question. The UN SDGs, the Sustainable Development Goals, 17 goals. There are, in fact, funds that attempt to address typically one or maybe two of those goals within the singular portfolio. So a good example is gender equality. Gender equality is the fifth SDG goal, and there are I think it's 5, maybe 6 funds that focus specifically on gender equality. Now, having said that, the portfolio management company's definition of gender equality may not specifically align with the UN's definition, but I think broadly speaking, it would be something to look for. Another one of the SDG goals is clean water and sanitation. And there's definitely a cohort of funds that is focusing on clean water. So that's an option. And certainly, climate and the environment by investing in green bond funds would tackle that SDG goal. In addition to that, there are a number of funds that use the SDG goals as a basis for screening their investments along with other considerations. So it's not specifically targeted at, I guess another way of putting it is the portfolio will not consist entirely of securities that are specifically aligned with the SDG goals, but the SDG goals would have been a factor in considering investment opportunities. So those would be some of the ways to invest in, if one is interested in specifically an ETF or a mutual fund that in one way or another tracks the SDG goals, that would be a way to invest in them.
Okay. Tom,
I
anything to add?
I don't have anything to add at this moment. That's a great question. And I know I'm continuing research on this with respect to goal number 7 about making sure that we end up with clean energy for all in the world. We started the century with roughly 2 billion people with zero access to modern, clean, safe energy. And it's an incredible public health problem and a problem binding people to poverty all over the world. So one of my very deep interests is helping to solve that problem on the technological level and helping to solve that problem through implementing projects that will bring smarter, better, inexpensive, but clean and safe energy services to the billion people who are still left, starting with sort of nothing.
Yeah. All right, great. Okay, our next question is, do any states offer any tax breaks for investments in state-based companies or organizations?
I can answer a little teeny bit, and this is the kind of thing that Michael Schumann studies constantly, and that NC3 is working on. Nova Scotia, as I recall, is the poster child of how to make this happen, and they offered a very generous tax incentive for investing in companies that are in Nova Scotia. The Michigan legislature has before it now a bill that would make Michigan the leader in the whole United States for doing this. I believe that the offer was intended to be a 50% state of Michigan tax credit for investing in Michigan companies. Now, that's a question for NC3. I know they're working on it. I know they tried to get the legislature to get it through before the end of the last lame duck session, yet it did not happen. So these bills are being introduced by both Republicans and Democrats. There is a reasonable expectation that it might get considered in this new session.
If I could add to that, there are, and if I understand the question correctly, there are municipal, there are focused sustainable municipal bond funds, which then, offer exemption either at the tax exemption either at the local level and or at the federal level as well. So there is a cohort of such funds, and these, unlike SDG aligned bonds, I think are growing in number because there is an appetite for them. And there is also one municipal green bond fund. That's one that's offered by Franklin Resources. It's an exchange traded fund. It's about $100 million. And it invests strictly in green bonds that were issued by municipal entities in the US.
Okay. All right. Hopefully that was pretty thorough. So I'm sure you answered that one. So our next one coming up is one of our participants says that she's heard that investors are pushing back on companies' ESG efforts, similar to DEI. And she was asking Henry if you could speak to that and what impact that's likely to have on companies' efforts to be environmentally responsible.
Yeah.
Interesting.
Well, I mean, we can spend a lot of time talking about what is transpiring as a consequence of the changing political landscape in the US. And you can definitely observe a pullback given increased litigation, given that regulations are being rolled back, regulations that promote, let's say, investing in the environment and in climate-related issues. Banks and investment management firms have been withdrawing from advocacy groups. And companies, I think, in general, have adopted a lower profile around some of these issues, whereas up until last year, they were in the forefront of being advocates. That said, I pointed to a survey that was done by American Capital. It was done in the middle of last year, but there have been other surveys closer to the time of Trump's election and post-Trump's election that seem to suggest that companies are not actually pulling back in terms of the actions that they're taking as part of their corporate strategies. And in fact, this weekend, Barron's published a survey of the top 100 sustainable companies, and it's subtitled "Coping with Anti-ESG Sentiment." This is a survey that's conducted by Calvert Investment Management, a company that has been in the forefront of advocating principles of responsible investing for many years, since actually their formation. And there's a quote in this week's edition that I think that accompanies the survey that's worthwhile, and that is, and it's certainly current. It says, while ESG critics have been cranking up the volume, the better barometer of the sustainability movement's strength comes down to a simple question: how committed are large companies to their sustainability goals? For now, most aren't backing off them, and many are making significant advancement. And that's according to Calvert Research.
Wow.
So I think, we're going to need a longer sort of time horizon in order to actually effectively evaluate what is truly going on beneath the surface. But I think there's anecdotal evidence to suggest and survey work that suggests that so far there is not a withdrawal from a strategic point of view on the part of these companies.
The other thing that I would mention is that in the global market, many of those practices are being internalized into all kinds of corporations. So to the extent that our giant multinational corporations want to be able to sell their products in other countries and want to have a supply chain that includes many other countries, um, they can't really stop all this activity because there is a lot of different governments and different reasons why the forward motion is continuing. It may be less publicly seen as a priority now, but it is continuing. And there was a very interesting piece of work done just a couple of years ago that showed on the climate action front, Michigan is home to some 37 of the Fortune 100 top companies in the world, all of which have made very sweeping climate commitments. And uh, none of them, as far as I know, have backed off the climate commitments, but they're much more quiet maybe about how they're doing it, but they're working on not only all their own emissions, but the emissions of everybody in their supply chain. So,
Mm.
this is affecting General Motors, Ford, Walmart, all the car companies, uh, and our chemical companies. And, this is not a small deal. It's a big sea change taking place over a long period of time.
Wow. Yeah. So we did have quite a few actually questions revolving around, the current political climate and how what what might happen, what's projected to happen, what some thoughts of, and so it sounds like you guys have really answered a little bit of that. Any more comments on that? We do have, let's see, quite a few saying, is it a partisan?
Yeah, yeah,
Is
yeah.
green investing like seem to be a partisan thing? And just kind of focus towards this administration and what might happen overall.
Well,
I'd like to say chaos. And I'd like to say,
I should narrow that down.
don't
With
let us get involved in the chaos. Let us be working on our own strategies and the things we can do, the things that are in our control. Um,
yeah,
all those issues, I know they're real. I know people are paying attention, but I find it troubling to try to pay too much attention.
yeah, true, so true. All right, so we do have a couple more questions if I have a few more minutes left. Let's see. One participant would like to know, how do you tell the difference between a fraudulent and a genuine investment opportunity on these platforms? Is fraud a worry?
Um, on the platforms that I'm using, like Honeycomb and Raise Green, there is a relationship between the platform and the entities that want to have a listing. So they run through a whole set of criteria before a listing gets qualified to be on their system. They're trying to prevent fraud and consumer ripoffs. It doesn't mean it's going to be 100%. And as I showed, I've had a couple examples that blew up in our faces, even though they looked so good. It's hard to imagine that they could have not resulted in success, but those things do happen. Um, if you owned stock in Sears Roebuck and Company, at some point maybe you were surprised that they couldn't somehow manage the transition to the internet world and shrunk incredibly, even though they were 100 and many years old and one of the first entities to try to figure out how to sell by catalog. Um, it's amazing sometimes to see who survives and who doesn't. Um, so I use my financial fiduciary advisors. I
Mm-hmm.
see things I think are wonderful. I say to them in their research department, do you have time to look at this? You know, and some of them come with a short time frame. You know, maybe this investment is only open for 60 days. Some of them we don't get the answers back in 60 days and I don't invest. Others I might decide at the end of 48 days, I'm going to go ahead and put $2,000 in this because I believe in it, but I'm not going to put $20,000 in because I don't yet know whether my fiduciary advisors think it's a really good thing to do. It's a constant source of amusement and entertainment. And I don't know how many people want to be do-it-yourselfers with all this.
No, I would not, but but more power to you if you want to. Henry, you want to add anything or
No, not on that.
no pressure? Okay.
Not-
All right, I have a few more questions then I'll try to get in. One of our participants is asking, any idea how badly the tariffs will hurt green energy? It's a good question. So whoever would like to handle that one, you could fight over it.
Um, I can't offer a clear response to the question. It depends on how the tariffs play out. I'm inclined to think that tariffs may have less of an impact than whatever may be stripped away from the Inflation Reduction Act, which was specifically intended to promote and advance the development of alternative energy, alternative renewable energy options to replace fossil fuels. That could definitely have a material impact, probably greater, at least in my assessment. And I don't focus on that particular area, but a greater impact potentially than any tariffs may.
And I guess my attitude about this is why project financing is so valuable, because we can know a whole lot in advance about any specific project. Suppose we're going to put 8 megawatts of solar energy on the Michigan State University campus, covering parking lots and so forth. We can evaluate ahead of time what happens if there's a tariff of 20% added to the market that's going to raise the cost of the solar panels in our project. We can evaluate those risks ahead of time. It doesn't mean that we can erase all those risks, because there is regulatory risk. And our utilities do happen to love changing the rules in the middle of the game so that this market does not have certainty and can't grow as fast as any other consumer market, which is annual doubling, by the way. So, it's a real concern. As individuals, we have practically no control over it. I would always be looking for a way to diversify this risk among 100 different projects, maybe in 100 different jurisdictions, so that the rules aren't all going to change in the same bad way in all the places. And maybe when we're investing in solar energy, we don't want to invest in one solar energy company, but we want to invest in 100 through a mutual fund or an ETF that's spreading that risk. It's a growing realm. It's going to continue to grow rapidly, but we do have to be ready to ride through some of these political waves that are going to be on the surface.
Right. The one thing, Tom, I would add to that is if we're talking about project finance offered through securities in the public markets, one guidepost that investors can rely on to evaluate the capacity of that particular transaction to repay its obligation in full and on time would be credit ratings. But that would apply to public markets mostly, even though there are private ratings that may be assigned to non-publicly traded securities. But I don't know where you would necessarily obtain those.
Okay.
This is partly why I think it'd be great if we could set up our own Michigan fund for investing in our own Michigan investments, of the devices and technologies that have been invented here, some of which are shockingly wonderful, like
Mm,
the clear window glass that is also a solar generator invented at Michigan State University.
mm. All right, we might have a few minutes for one more question, and this one is intriguing. Somebody had mentioned the term climate smart insurance. What does that mean? Have either of you heard of that, and do you know about it? In 2 minutes or less. No
I've
pressure.
not heard the phrase.
Ah,
I
But if
won't
you're,
project.
but if you're living on the coast of Florida, then I would say that it would be very smart to try to secure insurance for your home that may be at risk because of climate change and global and sea level rises, right? And
I would agree.
adverse adverse uh, uh, weather consequences.
All right. Well, thank you so much. That was fascinating. We had some great questions, and you provided wonderful answers, both of you. So we
Thank
have
you.
reached the end of the webinar, and I would like to hand it over now to our president, Kathy Petroni, who has a few words for us.
Great, thank you. I want to thank everybody that attended, and thanks to our speakers, Henry and Tom. I found the presentation very interesting. I'd also would like to thank our Eagers and Cafe for their work putting this together. And a special shout out to Donna Mullins for handling the technology and recording and organizing the webinar. You'll all receive a follow-up email with a link to the recording, the slides that were presented, and links to additional resources that were mentioned.